Hello everyone, welcome to the 64th episode of me learning how to trade in Forex. So in the last video we went through how to use Bollinger Bands. We met the guy who created it. Basically Bollinger Bands is like another version of the exponential, was it? Like the, what do you call it? Moving average envelopes. So you got the upper and lower bounds. Upper band, lower band, middle bands. The Bollinger bounce, so price tends to stray towards the middle of the bands. The squeeze, so squeezing and then price shooting. If a candle breaks above the squeeze, the upper band or lower band, then it's gonna continue rising, I think. Now we are on keltner channels, so yeah, let's get started. What do they call this? How to use keltner channels. Date is the 4th. So, keltner channels is a volatility indicator introduced by a grain trader named Chester Keltner in his 1960 book, How to Make Money in Commodities. So, keltner channels is a volatility indicator. A revised version was later developed by Linda Rasch. I'm not going to try because I'm going to pronounce it now anyway. In the 1980s. Linda Rasch in the 1980s. Linda's version of the keltner channel, which is more widely used, is quite similar to Bollinger Bands in that it also consists of 3 lines. However, the middle line in a keltner channel is an exponential moving average, and the 2 outer lines are based on the average true range rather than on standard deviations. Because the channel is derived from the average true range, which is a volatility indicator itself, average true range, the keltner channel also contracts and expands with volatility, but it is not as volatile as the Bollinger Bands. Keltner channels serve as a guide for setting trade entries and exits. So, keltner channels also contract and expand with volatility. Keltner channels, keltner channels serve as a guide for setting trade entries and exits. The keltner channel helps identify overbought and oversold levels relative to a moving average, especially when the trend is flat. Keltner channels help identify overbought and oversold levels relative to a moving average, especially when the trend is flat. So when there is no trend, basically. It can also provide clues for new trends. So, can also provide clues for new trends. Think of the channel like an ascending or descending channel, except it automatically adjusts to recent volatility and isn't made up of straight lines. Resistance at the top support the channel bottom, so bounce, 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 and then bounce, bounce. Okay. If you read our lesson on Bollinger Bands, you're probably guessing that keltner channels are basically cut from the same cloth. Well, almost. What sets these two apart are the underlying indicators and calculations that we could go on and on about, but might lull you into sleep. Let's just say that these formulas yield differences in price sensitivity and the smoothness of the indicators. How to trade Forex using keltner channels. keltner shows the area where currency normally hangs out. The channel top typically holds as dynamic resistance, while the channel bottom serves as a dynamic support. Keltner channels show the area where a currency pair hangs, where a currency pair's price hangs around. Keltner channel top typically holds as dynamic resistance channel bottom typically holds as dynamic support. How to use keltner channels as dynamic support and resistance levels. The most commonly used settings are 2 times ATR average true range 10 for the upper and lower lines, and exponential moving average 20, which is the middle line. So I'm guessing these are the periods, the time periods you're using. The middle line is pretty significant since it tends to act as a pullback level during ongoing trends. Pullback level. So, most commonly used settings are 2x average true range of 10 for the upper and lower lines, or should I call them channels, and exponential moving average 20, which is the middle line. The middle line is pretty significant since it tends to act as a pullback level during ongoing trends. Middle line is significant since it acts as a pullback level during ongoing trends. In an uptrend, the price action tends to be confined in the upper half of the channel, which is between the middle line as support and the top line as resistance. Alright, so in the upper, right, okay. So uptrend is here, price mostly tends to be up in here and not in here. So in an uptrend, what do they call it, price action tends to be confined in the upper half of the channel, which is between the lower line, not the lower line, the middle line and the upper line. Nice screenshot of this would do very nicely, like that, like that, like that. I'm guessing in a downtrend it's going to be most likely in the lower area. Yep. In a downtrend, price action tends to be confined in the lower half of the channel, which is between the middle line and the lower line. Bottom line, as they call it. Wait, so they call pullback to middle line. Pullback as in like it goes back up to the middle. Oh right, okay, I see. So I'm assuming there's gonna be like or before here there's gonna be like no trend, so it goes like that. And then if there's a downtrend, it goes here, 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 pull back to middle line. So it keeps pulling back to the middle line. So like here, and then here. Yeah, yeah, okay. In a ranging market, price usually swings back and forth between the top and bottom line. So it usually goes like that, probably. Right, okay, so in a ranging in a trendless ranging market, price usually swings between the swings back and forth between the top and bottom lines. How to trade breakouts using keltner channels. Breakouts from the keltner channel acts as strong hints where the price is running off to next, to off next. Breakouts from the keltner channel acts as strong hints where the price is running off to next. If the candles start breaking out above the top, then the move will usually continue to go up. Right, okay, so breakouts from the keltner channel, that's not your spell channel, act as strong hints as to where the price will head next. If the candles start to break above the top, then the move will usually continue to go up. So candle broken above the top here, and then it keeps going up like that. I'm assuming the opposite. If the candles start to break below the bottom, then the move will usually continue to go down. Okay, yep. So keeping an eye out for these channel breakouts can help you catch a big move as early as possible. So we can see the candle closing below the bottom and then keeps going down. There's another one closing below the bottom. Follow the outside line as well, maybe. Okay, next one. How to use the MACD indicator. How to use the MACD indicator. 0403-2024. Right, okay. What is MACD? MACD is an acronym for Moving Average Convergence Divergence. MACD is Moving Average Convergence Divergence. This technical indicator is a tool that's used to identify moving averages that are indicating a new trend, whether it's bullish or bearish. So This technical indicator is used to identify moving averages that are indicating a new bullish or bearish trend. After all, a top priority in trading is being able to find the trend, because that is where the most money is made. Okay, so with MACD chart, you usually see three numbers that are used for its settings. Chart uses three numbers for its settings. So the first is the number of periods that are used to calculate the faster moving average. First is the number of periods used to calculate the faster moving average, the number of periods used to calculate the slower moving average. Third is the number of bars used to calculate the moving average of the difference between the faster and slower moving average. The moving average of the difference. You can have a moving average of the difference. So is it just slower minus the faster one, maybe? Moving average difference. Yeah, it is the moving average difference of the difference average of the difference between the faster and slower moving averages. For example, if you were to see 12, 26, 9 as the MACD parameters, which is usually the default settings for most charting software, this is how you would interpret it. 12 represents a moving average of the previous 12 bars, 26 represents a moving average of the previous 26 bars, the 9 represents a moving average of the difference between the two moving averages above. Yeah, I don't really know how they got the 9 from, of the difference between the two. There is a common misconception when it comes to the lines of the MACD. There are two lines, the MACD line and the signal line. Represents a moving average of the difference between the two averages above. What's a moving average of the differences? Represents a moving average of the difference. So the difference between the two moving average, so it's the difference between the fast and the slow one. But isn't that just one minusing the other one? If it's the difference, but how come 26 minus 12 is not 9 though? A moving average. Oh, is it the average of the differences? So you could have like different differences for each bar, couldn't you? And then you would have the difference, and then you would have an average of them. I'm assuming that's what it means. It probably isn't. Hopefully it explains a bit more. There are two lines. The two lines that are drawn are not moving averages of the price. There are two lines of the MACD. The MACD line and the signal line. These two lines are not moving average averages of the price. The MACD line is the difference or distance between the two moving averages. These two moving averages are usually exponential moving averages. MACD line is the difference or distance between the two moving averages, usually exponential moving averages. Difference or distance between the two moving averages. So it's just the one average moving average minusing the other moving average, right? When looking at the indicator, the MACD line is considered the faster moving average. The faster moving average. So it responds more quickly to the price changes. It's considered the faster moving average. In our example above, so the 26 and the 12 and the 9 one, the MACD line is the difference between the 2012 and the 26 period moving average. Oh, so the MACD line would then be 14 because it's 26 minus 12, so that's 14. The signal line is the moving average of the MACD line. When looking, right, okay, so signal line is the moving average of the MACD line. How can you have a moving average of the difference? When looking at the indicator, the signal line is considered the slower moving average. Is considered the slower moving average. The slower moving average plots the average of the previous MACD line. The slower moving average plots the average of the previous MACD line. Once again, from our example above, this will be a 9 period moving average. But how come it's 9 though? Where did they get 9 from? Most charts use a 9 period exponential moving average by default. That's not why it's 9, would it? This means that we are taking the average of the last 9 periods of the fast MACD line and plotting it as our slower MA moving average. So it's just the average of the differences. Oh, right, okay. Oh, right, okay, because you're taking the average and then plotting it as oh, right, okay. The purpose of the signal line is to smooth out the sensitivity of the MACD line. It's to smooth out the sensitivity of the MACD line. The histogram simply plots the difference between the MACD line and the signal line. Histogram plots the difference between the MACD line and the signal line. It is a graphical representation of the distance between the two lines. It may sometimes give you an early sign that a crossover is about to happen. So if the greater distance, the bigger the bar. So when you see like a long bar coming up, that means you know, no, you want to look for a short bar, don't you? Because that means when the distance is really close. So that's when the close crossover is about to happen, is when they're really close to each other. If you look at our original charts, you can see that as the two moving averages MACD and signal line separate, the histogram gets bigger. Yeah. So that bit's the biggest here because they're really far from each other. This bit's close, so they're literally right on top of each other. There's no like distance between them, so there's nothing here. So you basically want to look for like as little bar as possible to show where they cross over. So as soon as the toolbars fall, then you know that crossover is about to happen, basically. This is called a MACD divergence. MACD divergence. Because the faster moving average line is diverging or moving away from the slower moving average. When the faster moving average is moving away from the slower moving average. MACD convergence. When the faster moving average is moving towards the slower moving average. Getting closer to the slower moving average. Yep. And that, my friend, is how you get the name moving average. Oh, convergence, divergence. Right, okay. Phew, we need to crack our knuckles after that one. Okay, so now you know what the MACD does. Now we'll show you what MACD can do for you. How to trade using MACD. Because there are two moving averages of different speeds, the fast one will obviously be quicker to react to price movement than the slower one. Yep. When a new trend occurs, the faster line, the MACD line, will react first and eventually crosses the slower line or the signal line. When a new trend occurs, the faster MACD line will react first and eventually cross over the slower signal line. When this crossover occurs and the fast line starts to diverge or move away from a slow line, it often indicates that a new trend has formed. So we can see that these two lines are getting closer and closer on top of each other, and then it starts to growing further apart again. And that's when the trend's formed, right? From the chart above, you can see that the fast line crossed under the slow line and correctly identified a new downtrend. Faster line crossed under the slower line. So the blue line here crossed under the red line here, right here. Notice that when the lines cross, the histogram temporarily disappears. Are they talking about here, aren't they? Oh, right, okay. Right. This is because the difference between the lines at the time of the cross is 0, yep. As the downtrend begins and the fast line diverges away from the slower line, the histogram gets bigger, which is a good indication of a strong trend. As the fast line diverges away from the slow line, the histogram gets bigger, which is a good indication of a strong trend. Let's take a look at an example. In EURUSD's 1 hour chart above, the fast line crossed above the slow line whilst the histogram disappeared. This suggests that the brief downtrend could potentially reverse. From then, EURUSD began shooting up as it started a new uptrend. Imagine if you went long after crossover, you would have gained almost 200 pips. There is one drawback to MACD. Naturally, moving averages tend to lag behind price. Drawback to MACD is that moving averages tend to lag behind the price. After all, it's just an average of the historical prices. Remember, the MACD indicator consists of 3 components. What are rates and drawback of MACD is that movement tend to lag behind the price. Yep. The MACD line, which represents the difference between the two moving averages, the signal line, which is the moving average of the MACD line, the histogram, which is a graphical representation of the distance between the MACD line and the signal line. That said, MACD is still one of the most favoured tools by many traders. Consists of 3 components: MACD line, signal line, and histogram. How to use parabolic SAR. Parabolic SAR. Oh, they capitalized it all. Right. Up until now, we've looked at technical indicators that mainly focus on catching the beginning of new trends. Although it is important to be able to identify new trends, it is equally important to be able to identify where a trend ends. After all, what good is a well-timed entry without a well-timed exit? True. One indicator that can help us determine where a trend might be ending is the parabolic SAR, stop and reversal. Parabolic stop and reversal is an indicator used to determine where a trend might be ending. A parabolic SAR places dots or points on a chart that indicates potential reversals in price movement. Whoops. Parabolic SAR places dots or points on a chart to indicate potential reversals in price movement. From the image above, you can see that the dots shift from being below the candles during the uptrend to above the candles when the trend reverses in the downtrend. So the dots are below the candles when it's uptrend, and then as soon as it reverses, it goes above the candles and it starts going down as well, and then it goes up. So I'm guessing whenever there is an uptrend, the dots are below the candles. Whenever there's a downtrend, the dots are above the candles, and it mainly follows the shape of the trend as well, the gradient. So maybe. How to trade using parabolic SAR. The nice thing about the parabolic SAR is that it's really simple to use. We mean really simple. Basically, when the dots are below the candles, it's a buy signal. Yep. So if dots are below the candles, it's a buy. If dots are above the candles, it's a sell. Sell here because it's above. Buy, sell, buy, sell, buy. Simple, yes, we thought so. This is probably the easiest indicator to interpret because it assumes that the price is either going up or down. With that said, this tool is best used in markets that are trending and that have long rallies and downturns. Best used in markets that are trending and have long rallies and price downturns. You don't want to use this tool in a choppy market where the price movement is sideways. Don't use it in a trendless market. How to use parabolic SAR to exit trends. You can also use the parabolic SAR to help you determine whether you should close your trade or not. Check out how the parabolic SAR works as an exit signal in EURUSD's daily chart below. So when it's above, we sell it, sell, 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 and then candles went below. Oh no, the dots went below the candles. 1, 2, 3 dots. Time to exit my short trade. So buy, 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 buy. 3 dots again, uptrend will probably end. So 3 dots is a confirmation dots basically. But before that, when Euro USD started gliding down in late April, it seemed like it would just keep dropping like a rock. A trader who was able to short this pair has probably wondered how long it continued to go. In early June, 3 dots formed at the bottom of the price, suggesting that the downtrend was over and that it was time to exit these shorts. If you stubbornly decide to hold on to the trade thinking that Euro USD would assume its drop, you probably erased all those winnings once the pair eventually climbed back up near 1.35. So, copy trade exits can be determined using the 3 dot method to show where can be determined using the 3 dot method to show where the exits are, right? No, I already said that. Traders can be determined using the 3 dot method. Alright, let's just leave it at that then. 49.99. Is there no downsides to this? Because I haven't mentioned any. Okay. Anyways, how to use the stochastic indicator. How to use the stochastic indicator. '04/03/2024. The stochastic oscillator is another technical indicator that helps traders determine where a trend might be ending. Stochastic oscillator is a technical indicator which helps traders determine where a trend might be ending. The oscillator works on the following theory. During an uptrend, prices remain equal or above the previous closing price. During the downtrend, prices will likely remain equal or below the previous closing price. This simple momentum oscillator was created by George Lane in the late 1950s. So, during an uptrend, prices will remain equal to or above the previous closing price. During a downtrend, prices will remain equal to or below, right? Below the previous closing price. This simple momentum was created by George Lane in the late 1950s. Stochastics measures the momentum of price. If you visualize a rocket going into the air, before it can turn down, it must slow down. Momentum always changes direction before price. True. The stochastic oscillator uses a scale to measure the degree of change between prices from one closing period to predict the continuation of the current direction trend. Stochastic oscillator uses a scale to measure the degree of change between prices from one closing period to predict the continuation of the current direction trend. The two lines that are similar to the MACD lines in the sense that one line is faster than the other. So you still have a short and long, or short or fast moving average, right? Or if they're even moving average lines. The stochastic technical indicator tells us when the market is overbought or oversold. The stochastic is scaled from 0 to 100. When market is overbought or oversold, the stochastic is scaled from 0 to 100. When the market is overbought, the stochastic line are above 80 when it's overbought. The red dotted line in the chart above, so it's a red one. When the market is oversold, the stochastic lines are below 20. Possibly oversold, possibly. As a rule of thumb, we buy when the market is oversold and we sell when the market is possibly overbought. When the market is oversold, possibly, what? When the market is oversold, buy. When it's overbought, sell. Overbought. Oh right, here's the 80 and here's the 20 lines. Alright, I see. So the stochastic lines overbought above 80. So both of them above 80, then it's overbought. Right, okay. And because it's overbought, we need to sell, so sell here. We need to start selling here. Looking at the condition, looking at the currency chart above, you can see that technical indicator, you can see that the indicator has been showing overbought conditions for quite some time. Based on this information, you can guess where the price might go down, right? Overbought, yep. So that's why sell when it's overbought. If you said the price would drop, then you're absolutely correct. Because the market was overbought for such a long period of time, a reversal is bound to happen. That is the basics of stochastic. Many Forex traders use the stochastic in different ways. But the main purpose of the indicator is show us where the market conditions could be possibly overbought or oversold. Main purpose of the indicator is to show us where the market is possibly overbought or oversold. Keep in mind that stochastics can remain above 80 or below 20 for long periods of time. Stochastics can remain above 80 or below 20 for long periods of time. So just because the indicator says overbought doesn't mean you should blindly sell. The same thing if you see oversold, it doesn't mean you should automatically start buying. Don't be a stochastic sheep. Stochastic, so one person does it, you follow. Over time, you learn to use the stochastic indicator to fit your own personal trading style. Okay, let's move on to RSI. Okay, I'm going to leave this episode here. Thank you very much for watching. In the next video, we're going to carry on doing this with how to use the relative strength index. So yeah, thank you guys for watching again, and I'll see you. Peace.